we were trying to identify imperfections in the management of what was predominantly institutional owned real estate, and an employer, being a much more, a smaller organization, employing a sort of proactive approach to the management of those assets, really. The returns in real estate, particularly in the low interest rate environment that we've been through, have been very attractive. So it seems to be a fairly well-trodden path now that private equity capital of that nature, will allocate money to operating partners like ourselves and others.
Welcome to the People Property Place podcast. I'm delighted to say that Tim Lumsdon, founder and CEO of Marchmont Investment Management, a leading operating partner to institutional capital, specialising in UK real estate strategies, joins me on the show today. Tim set the business up in 2011 and is responsible for the overall business and investment strategy. He started his career with BNP Paribas Real Estate before joining SG Commercial. He went on to become a fund manager at Tritax before setting up Marchmont, and it gives me great pleasure that he joins me here today. So Tim, welcome, and thanks so much for joining.
Thank you. Thanks for having me.
Not at all. Well, look, as you know, we'll get onto Marchmont further on in the conversation, but a question that I love to find out and ask first is how and why did you get into real estate and decide to pursue a career in this space?
Yeah, well, I guess I had a general interest in business economics when I was at school, albeit the predominant focus was on sport at the time. But when there was academic focus, that's where it was. But I didn't really have any direction as to where I felt that I could take that, or where indeed I thought that would sit. And I think it was actually my dad, who's an engineer, suggested that I go and do some work experience with a company called Sanderson, Townend and Gilbert, who are a chartered surveying practice based in Newcastle, which I did. So I took the, I guess, quite binary decision at that point to apply to do an estate management degree, which I did at Heriot-Watt University. So up in Edinburgh, which was fantastic experience, tremendous city, interesting degree course, but probably a bit more academic theory based than perhaps I'd expected, and I guess that was what drove me to seek out some experience in the sector to establish if that really was where I wanted to end up. And I was very fortunate to get a data inputting role with a company called Weatherall, Green and Smith, as we'll probably come on to. That's now BNP Paribas Real Estate. They had a lovely office in Charlotte Square. And I, as the role suggested, was really a support, data entry, helping with the comps for the rent review guys, the valuers, great team up there. A guy called Andy Cartmail was my boss, and they really treated me as a proper employee, even though I was just sort of dropping in on a Friday, doing a few hours, and then picking up a few Scottish notes in a brown envelope at the end of the day. But it was great experience. The role evolved a little bit into sort of summer internships, if you like, and allowed me to perhaps get a bit more involved beyond just the data entry. And I think that was what really cemented my interest in the sector, and I guess also the acknowledgement that the sector had a wide breadth of roles that you could pursue, which in itself was interesting. So that was really university, and I guess that Stephen Hurd, who ran the office there at the time, was very kindly said, look, there's a role here for you when you graduate. But he said, having himself just come back from a stint in London, he said, there's a lot of experience to be had down in London, and that's what I did for a couple of years. That was 23 years ago, I think now. So
a couple of years ago,
a great grounding with those guys up there, and obviously it facilitated my joining the graduate program with what was still Weatherall, Green and Smith. Then went through a few different iterations of Weatheralls and Attis Real, and a few T-shirts along the way, but finally became BNP Paribas real estate, which is where I trained and qualified.
So before we get onto that, you touched on kind of growing up, just love sport. Did you want to be a professional sports person, or was that the kind of the main?
I think I knew early on that was probably unlikely, but I think that was really my social outlet, and I loved it. We played a lot of golf, a lot of football, a lot of tennis, and it was something that I really enjoyed. I got by academically and did what was required, but I think from a passion perspective, it was all about the sport, and to an extent still is. So.
And you touched on your dad did engineering. Did you have anyone else in the family that did property or real estate? Or?
No, so I didn't. There was no background to real estate really. So it was, I guess, in hindsight, a slightly odd trajectory to pursue or opportunity to pursue. But I think in hindsight, and I think particularly looking at this sort of jobs market now, I would have probably done a more general, perhaps economics or business degree, just to keep those options open. I think what we do, a lot of it you learn when you're in it, as distinct from in a classroom, if you like. So, but fortunately, it was something that I enjoyed, and I guess from a vocational perspective, led me to hopefully the right role. But certainly at the time, there were very few non-cognate applicants to the graduate program. We were almost all from a real estate degree. You'll know better than anybody else. That's changed somewhat now to the benefit, I think, of our industry. I think people bringing different skill sets is a positive thing. But back then it was a
pretty well-trodden path.
Pretty well-trodden path.
So you got on the train, came down to London, did you, or did you start at BNP up in Newcastle? Or
up in Edinburgh, but then moved down with with some friends and then girlfriend, now wife, and had a great time. And unbeknown to me, the Clapham was the surveyor's world, but I only through a recommendation of a friend ended up living there and pretty much have ever since. But had a great time, and I think very fortunate to be on a graduate program which was very well structured, but also within a business that was very encouraging of young people in the business. So I've got a lot of good friends and people I've done business with who I worked with back then in sort of 2001 onwards.
So what was those rotations, that kind of initial grounding that you had?
Yeah, I was. I ended up very much in a sort of an investment side of things. I started off in the development funding team, where I was putting the dots on the maps, but the team was advising the likes of Development Securities, as was then Helical Bar, on quite strategic, large-scale developments, predominantly offices, which was great grounding and a real, exposure to that asset class, if you like, and also the financial modelling that went around it. And then I actually did my valuation rotation in the secure lending team. So we were doing valuations on behalf of banks, which again I think was a really interesting slot because it had an element of transactional aspect to it, because we were valuing in support of transactions that were going on. That was really interesting, and then ended up in the investment agency team, which was a national investment agency team across all sectors, which was fantastic. Yeah, some great people, and a great time in the market. It was it sort of come through and beyond the dot-com bubble, and the market was strong. Interesting to think of who made up the client base at that stage. I don't think anybody had really heard of private equity real estate at that point. It was very institutional in its makeup, certainly at our business. The likes of Aviva, CCLA, Legal and General. That was the bedrock of the clients who we were advising.
DB pension scheme.
Yeah, and a couple of which were actually managed in-house as well, which was interesting and done by a couple of of really impressive characters who I think I learned quite a lot from in hindsight.
So did you always, once you got into it, did you always have a disposition towards investment, as in terms of that's where your interest and skill set kind of aligned?
I think so. I'm not going to say it was some grand plan to end up there. I think it was clear that my skill set was probably well suited to that side of things. I enjoyed the analysis and it was a very people-based business. It necessitated that socializing, and I'll be honest, I wasn't the best investment agent in the world, but I enjoyed it, and I enjoyed the getting in behind what the objectives of the clients were, and it was I guess that's what triggered the ultimate desire to be on that the other side of the fence, along with being a relatively average investment agent.
So you were at BNP for just shy of 7 years or so and left in January 06, if my dates are correct. And you went to go and join a business called SG Commercial. Why was that, and how did that come about?
I did, yeah. I think one of your previous guests, Rob West, probably articulated the background to SG Commercial, but it was a business set up by James Dunlop and Colin Godfrey and Rob. James and Colin were ex-Weatherall's employees, as was. Who I didn't actually, they weren't there when I was there, but I knew of them through contacts that they still had with Weatherall's, and I think from a personality perspective, felt really aligned with what Colin and James were trying to do, I think it was a natural opportunity to perhaps get a little bit more responsibility. Colin was actually a fund manager in one of the aforementioned in-house funds at Weatherall's, and so he was very much, and obviously then became on the Tritax side of the business. And I think there was a real attraction there to having that sort of dual role of advisory and also potentially sitting on the other side of the fence, as we put it. So it was a great opportunity and a fantastic period, really.
And so what role were you doing exactly when you joined SG? Yeah,
so the predominant role on the sell side was to manage the disposal of a lot of the Tritax enterprise zone investments. So pre-big box, Tritax had built the business around syndicated high net worth money, which they were investing initially into tax-based products in enterprise zones. So, they were everywhere from Greenock to Eurocentral, Maxim on the M8 between Glasgow and Edinburgh, but also Newcastle. So it's back to my roots, and you had a lot of, I guess you would describe them as sort of cost-conscious occupiers like T-Mobile, Orange, big call centres in these offices, and the liquidity for those assets became more challenging. But I was fortunate at the point where I was charged with trying to dispose of them, that we did quite a lot of deals. On the other side, on the buy side or advisory side, we were doing a lot of work with a combination of family offices, institutional capital, Chancery Gate, Helical Bar, and I guess the genesis of the Marchmont business was a relationship that I had with a family office, which came about in, I would say, sort of 08, 09. The beneficiary of this, what was actually quite an institutional trust managed by Royal Bank of Canada in Jersey. The beneficiary was a high net worth individual who, I guess, best described as somebody who was seeking an exposure to real estate, didn't want to come in via a pooled vehicle, wanted the autonomy and the control, but didn't have the time or the expertise to execute the strategy, I guess. So I advised him on 3 office buildings, one in Victoria, one in Wimbledon, and one in Croydon. And really that became the sort of the trigger to effectively formalize an investment management business to grow on that capital base.
Because you touched on, if we just rewind the conversation, high net worth syndicated capital. Can you, for someone who doesn't know what that means, that mouthful, can you just explain how the mechanics of that work and how it comes together in reality?
I mean, the regulations have changed. I guess the business that Tritax had was similar to that of Merchant Place or Matrix, for example. And really, it was the IFAs, so the Financial Advisor Network, who would be advising their clients on diversified portfolios. And these businesses, Tritax being at the forefront of that, was an opportunity to gain exposure to to commercial property. Initially, they were doing that through sort of tax efficient wrappers, if I can put it that way. But latterly, when I was when I moved over onto the Tritax side of the business, we were putting together non-tax based products, just syndicated investments. We bought, for example, the IHG headquarters in Denham. So you might have had 200 investors putting in, anything from maybe 10 to 15,000 each to up to maybe 100, 150,000. So it was truly syndicated capital. The legislation around that has changed slightly now, but and obviously Tritax evolved out of that into what they're doing now. But for example, when they were in sort of 06, 07, there was a desire on behalf of those supporters of Tritax who had done very well in their partnership with them to expand. And one of those opportunities that Tritax identified was the Polish market, which was fascinating. I think probably by virtue of the fact that I was the only one willing to go back and forth to Poland every other week, became very involved in that right from the sort of embryonic stage of assessing the opportunity from a demographic macro perspective through to the capital raising. So I was quite involved in that capital raising again. That was done through the IFA network. And then I was responsible for the implementation of the strategy that Colin and Mark had identified alongside an operating or an asset manager in Warsaw, which was fantastic. I mean, very grateful that they entrusted me with that role, which I really enjoyed. Great partners in Poland. Learned a huge amount about that country. Can't speak highly enough of the people there, and the opportunity was interesting. I think I guess as I reflect on it now, it's easy in hindsight, but the market there was clearly evolving as the country was evolving itself, and there was a big expectation that they would continue to see significant GDP growth. The likelihood was that they would join the euro. That still hasn't happened, and this was quite a while ago now. But there was a lot of capital, and I guess until we were in the market, or I was in the market, certainly the realization of the origin of that capital was quite interesting.
You touched on the genesis of Marchmont being a high net worth individual who was an investor probably in one of these syndicated funds, who, rather than getting pooled with a load of different investors, wanted to have more direct control and access. Can you just talk to me about how and why you set up Marchmont, and had you always had that entrepreneurial itch?
Yeah, disappointingly for the podcast, no. I almost on the contrary, I really enjoyed the big corporate. I really enjoyed when I was at BNP Paribas. I did when the business I worked for, which was latterly Atis Real, was bought by BNP. There was a huge amount of work and time and money invested in trying to look at cross-selling between the European businesses that they bought, which was a very big business in Germany called Muller's, one in Paris called Auguste Touard, and Weatherall's in the UK. And I was lucky enough to be involved in some of the endeavours to do that. That was quite revealing in itself. I know we did a piece of work in Paris, which was actually for a German client in who had a portfolio of Paris offices, and I went over there to try and support the sort of financial analysis of what they were doing, which was one of the more challenging roles I've had. I think my wife will laugh that she was on the other end of the phone as an actuary trying to help me through the spreadsheets at night. I think we probably clocked up more on the mobile phone bills than we should have. But really interesting. I think what at the time the big challenge was that the broker markets around Europe and I guess the USA, etc., are very different. So in the Paris market, for example, it's very much eat what you kill, and the guys there weren't even really talking to each other. Never mind us when we came over. So it is, I can see how challenging that integration can be for businesses looking for pan-European exposure. But I think it was a really interesting time to be involved in what was then a big corporate, big bank. So no, I mean, if anything, if you'd have asked me then, that's the trajectory I would have tried to stay on and grow within a bigger organization. And I guess sort of iteratively, I ended up getting smaller and smaller when I worked back down through SG, and obviously briefly Tritax was bigger, but at the time when I was working with them, Tritax was still a very small business. There was only 5 or 6 of us working in London. Contrast that to now, obviously. But there was no sort of budding desire to be an entrepreneur. But I think what we did, along with the investor who supported me initially, and I think working with somebody who wasn't in the sector was a really interesting outlook, because they were viewing real estate from a much more top-down macro opportunity. It wasn't, inevitably, having worked in the sector from day one, you're inclined to view it from a sort of ground-up occupier, investor market, etc. But I think what was really interesting was how the investors coming from other sectors view the opportunity. And I think, it became clear that there was a desire to try and grow the exposure for this investor and hopefully then add other like-minded investors to it, principally through this relationship that had prevailed with RBC. So what we had was a very institutional counterparty in an offshore managed trust, but behind it was one and ultimately multiple beneficiaries who were very opportunistic. And I guess the strategy of Marchmont initially was largely directed by that desire of theirs, really to be reactive to the market opportunity rather than look at it as some sort of allocation play. They were of the view, which I supported, that this was a very interesting, compelling buying opportunity through 2010, 2011, 2012, where the market was not awash with buyers, and I guess a little bit like we've seen in the last 12 months. There were institutions who were, if not forced sellers, certainly motivated sellers, so really, that drove what at that time was a largely sort of sector agnostic view to the market, because it was really identifying the either imperfections in a sales process or a management process that we were looking to to take advantage of, and I guess, and I say this very carefully, given the many of the listeners and indeed my colleagues have come from institutional backgrounds, but I guess what we were doing then was buying the smaller assets from the bigger institutions, which practically these guys, when there's small assets in £1 billion funds, the smaller deals can't be the focus, or perhaps they've aggregated these through different portfolio acquisitions. And I guess put very simply, we were trying to identify imperfections in the management of what was predominantly institutional owned real estate, and employ being a much more a smaller organization, employing a sort of proactive approach to the management of those assets, really.
And so, as you touched on, you're sector agnostic. So, and in terms of the investable universe, there was it retail, office, industrial mainly that you would look at?
Yeah, I mean, I think our bias, and I should say that at that point, about 6 months to a year in, I was fortunate to be able to lean on the infrastructure that the family office had in place for other strategies that they had outside of commercial real estate. So I wasn't sitting entirely by myself in an office. I had a team around me who were doing different strategies, but also gave me the sort of framework of and infrastructure of their business, which was great.
In terms of what, like lawyers, accounts, and
accounts, lawyers, exactly that.
An office environment, an address.
CFO who was able to to help guide me through that setup, that establishment. Which was great. So it wasn't I think when you think you set your own business up, I wasn't. I had the 3 assets that we'd acquired and sort of converted into sort of day one AUM, if you like, and B, we had the background of the infrastructure that the family office had. So it was a really interesting opportunity. But I think my experience to date at both Tritax and BNP was largely on the investment side, financing, structuring side. So I didn't have the experience of the value extraction from, asset management. And I think, that really is where, through to today, is our sort of USP. And Julian Perry, who's one of my partners in the business, joined at that point from Catalyst Capital, just across the road here, where he'd spent more than 10 years, in a very, very value-add strategy, which had given him huge amount of exposure to everything from planning strategies, leasing campaigns, rent reviews, the whole spectrum. And again, they were, largely sector agnostic as well. So he had experience across the piece. So I guess what we were able to do, I think our first deal, which is always the key one that we were clinging on to, and I'll name no names, but the people who helped me keep a hold of that deal, one of whom was a previous colleague at the fund who we were buying from, probably gave us more time than perhaps others would have afforded us, but we were going to get there. It was just, at that time you'd expect we were putting structures together. We were bringing debt side by side. We were fortunate to be given the time to buy a portfolio of 10 assets from a fund, everything from retail warehouse, high street retail, offices, leisure, gym in there. So, and I think, what that gave us was the ability to really get our teeth into, we had high conviction that this was a good point in the cycle to be buying, but I guess, our underwrite was really underpinned by being able to extract value from the value add strategies that we were to employ from an asset management perspective. So, I have to take my hat off to Julian for that rather than me. I was, I could tee them up. But I think, at that point, what was really important was that there was no separation between the investment and the asset management. And it's something that we still today find, critical to what we're doing, and ensuring that, when we're underwriting new deals, the asset management team are intrinsically involved in that, because the reality is, that they're going to be responsible for the execution of that. So, we spend a lot of time as a team, across the disciplines, including development management, asset management, and investment, making sure that, we're all aligned, so that when that contract gets signed, everyone's behind the business plan. So
rather than the investment guy just dropping the file to the asset manager going, look what I've just bought, try and make good of that.
Yeah, indeed. Yes. So that was great. And really, along with an analyst who joined, it was really the three of us for the first 3 or 4 years. And we grew the capital base quite organically, I would say. As people say, you've got your own business. I say we've added a person a year in 12 years or 13 years. But, we weren't seeking scale for scale's sake at that time. It was really about crystallizing performance to just improve the credibility of the business to grow through the next stage. And it was fairly embryonic, but we were fortunate that the market went with us as well, which clearly was an added advantage rather than something we were banking on. But and with that, we were able to crystallize track record. We were we became a regulated entity, which meant that the rigor of the FCA had gone through the business, and we had the right practices in place. And I think, but it was clear if we wanted, the private capital at that stage was, the market had become more normalized, so there wasn't the obvious buying opportunity for somebody looking at the sector from a very opportunistic basis. We wanted to grow the capital base perhaps more into a institutional with a small I, if you like. And we realized that really we had to be more thematic in our approach in order to do that. And I guess this is sort of 2016, I guess we were at that point where we as a business had great crystallized track record, good platform, well known in the market, or relatively well known in the market, but it was opportunistic that a contemporary of mine in the industry, I guess, Cam Fraser, who's a well-known Kiwi in the industry, having held quite senior roles at CBRE GI and latterly head of the balance funds at Nuveen. He was seeking a platform to really pursue what, at that stage was an early mover, but into the whole urban logistics, last mile logistics theme. And, it was a very opportunistic connection, because, we had the platform, we had the track record. Cam had the thematic, strategic idea to take to the next stage of the business. And, it was perfect. So Cam became a partner of the business, and despite his institutional background, is actually probably the most entrepreneurial of all of us, and pushes themes, pushes strategies, and it's a really good push-pull in the office with ideas. And so Julian, Cam, and I, we had then that opportunity to take and try and grow a business around what then became
Marchmont as it is today.
Marchmont as it is today, I guess. Yeah.
So when you set the business up, did you have a business plan and a structure, and was it really formulaic, or was it just a case of you had the partner who was clearly family office, opportunistic, looked across lots of different sectors and the investable universe, and wanted to allocate some capital to commercial real estate? Was it a case of, Tim, just go and make me some money, or just go and buy some mismanaged?
It's just going to come across that I neither had a budding desire to be an entrepreneur or a plan, but I did have something of both. But I think I think the original business plan really was to try and grow a platform to facilitate that aggregated capital, but from a rather than the sort of granular nature of the IFA money, a bit like Citi and Threadneedle have done so well with their select funds. You're utilising the bank's capital relationships, and then you get really good operating partners in James Rigg and Tim Bowring at Citi was an ex-colleague of mine. That model of working with at that time was RBC. We had a really good track record with the RBC guys, and we got sort of derailed slightly by the fact that RBC went very risk off on a lot of things, really, and effectively sort of retrenched the business back to Canada. So we were somewhat stopped in our tracks, I guess, in what would have been the original business plan. However, as I think you've got to be quite flexible to the opportunity, and as it happened, we then, I guess, went from pursuing having our own fund and control, which obviously has a lot of benefits, to sitting in more of an operating partner model. And really, I think with that, trying to really exploit what we consider to be our real USP, which was the ability to originate through our collective networks, to execute. We've been doing this a long time now, and then manage. And I think that. We pivoted. I'd say where we are now is not where the business plan would have looked like when we first started. But one of the benefits of the sort of infrastructure that the partner had on day one, if you like, was they had an FD and a business that they could help shape that. Whether you stick to the business plan, it's always good to have one.
It's I just love the fact that was the plan initially, but then as it's evolved, it's kind of pivoted, and as you said, now you're a UK focused operating partner to institutional capital, and you take advantage of the opportunities. You find the deals, structure the deals, manage the deals, but you go and get institutional capital to invest or have majority equity in the deals. Cam, who's obviously working at Nuveen, a big institution, he's the kind of guy that you would have bought deals off of in terms of the smaller mismanaged sizes, right? And so he's kind of moving from an allocator to an operating.
Yeah, and I think that probably speaks to his personality as an entrepreneur. He has a great relationship with the guys at GI and Nuveen where he was, and I think he just saw the market opportunity, and I think it's not often easy for these bigger institutions to pivot to the opportunity quickly, and that's what he wanted. And fortunately, we were able to sort of offer the platform to do that.
So he came into the business, and what was the idea, and what was the theme, and what was the strategy at that stage?
Going back to the basics, we over the 20 odd years that we've all been doing it, we loved industrial for its old school. Benefits of granular income streams and, low obsolescence. So we'd all done a lot of that industrial, and, we'd often found, very low vacancy rates, with active tenant management. Obviously what you then had was a huge structural shift in, retailing habits, and, in that online penetration, really cemented it as a, obviously the sector that it's become. But I think we saw an opportunity from the ground up to try and take advantage of that. And we didn't get too restrictive in our parameters around how urban it had to be, or clearly we were looking for locations where the supply demand imbalance we felt would leave us in a strong position to execute management initiatives that would advance income, which is ultimately what we were trying to do. Clearly, what we then benefited from was a huge capital compression, yield compression over the same period. But I think the thing that we probably are most proud of is the advancement of the income, because that's ultimately the thing that we're in control of, other than the timing of the buying, which really speaks to the teams on the ground.
Rather than just buying and just riding the market.
The reality is, for us as a business, we have to be shown to add value rather than just, so buying, whilst we have some single-out assets within our portfolio, and we'd like to think that we can offer, differentiated origination and execution positions there. A 25-year lease is a 25-year lease, so you're at the whims of whatever the market does in the intervening period. But with the more granular assets in the urban logistics, and latterly we got more into development. It's creating that product, which has been great.
So, can you just talk to me about the portfolio today, and what makes up the business, and what does that look like?
Yeah, so we manage about 750 million. And really, I guess if you asked somebody in the market what traditional Marchmont kit was, it would be granular value add existing assets, which is where I guess we cut our teeth. And really, that geographically, we tend in portfolio composition to look at a core of Southeast Greater London, but then we really like the regions. The first fund that we did with NW1 Partners, we did 8 assets in and around London, and then we bought Trafford Park and an asset in the Birmingham Ring Road. So when we've gone regional, we've gone into the core markets where we've got conviction around liquidity and supply demand imbalance. But we manage assets from Glasgow down to a lot in the southeast, which are a combination of some more institutional boxes, mid boxes. We just bought a portfolio with ICG as partner of assets from AXA, which are very institutional boxes. However, they do have a lot of lease events coming up and value to add. And then we have a large platform with Pictet, the Swiss private bank, which is a lot of value add, predominantly multi-let assets, where we're really working through quite intensive business plans, part redevelopments, and then within. We've done a couple of out-and-out developments. We bought the Virgin Atlantic training headquarters in Crawley with Pictet just post-COVID, where we did a short-term lease back to Virgin whilst they relocated their facility, and then we demolished that and constructed just under 250,000 square feet, which we sold to NFU. Quite a broad breadth of grade A, slightly bigger boxes down to quite granular 1,000 square foot value add strategies.
How do you go about sourcing or working out, from a conviction perspective? You touched on that a couple of times. Like where and how do you follow your nose or find these deals or know where to kind of look?
Yeah, but I think on the origination side, Cam and I and James, who's one of the investment directors, spend a lot of time, with the agents. We were agents, and through that, I've got a good network of what have become a lot of friends within the industry. And so I think from an origination perspective, the agency network performs a really important function in our UK market. We've also done deals direct with vendors where we've had relationships that's been the right thing to do. So origination side is one thing. I think on the conviction side, obviously we had and continue to have very strong conviction around the industrial market, just because of that supply demand imbalance, which we think is still permeating, and should be supported by the lack of new build product, which will come through owing to the viability challenges of the last 12 months. But But yeah, it's it's all about the underwriting. Yeah, so it's all about getting local occupational advice, understanding how these markets have performed through different cycles, not just looking at snapshots of vacancies at any one point in time. Looking at almost always there will be multiple scenarios that can or will prevail, and doing as best we can, trying to understand the implications of those on returns. It's there's a lot of facets that come in, and again, that's where the analysts that we have do a great job in being able to adapt to all the different assumptions that the asset management guys are feeding in on, if that tenant goes, that's capex there, and we've gone and so there's, it's quite multifaceted, the underwriting process. And, we tend to do a lot of that work early on in the process, to ensure that, we don't have wasted deal time or deal costs in due course.
You touched on, ICG and Pictet. Have you seen the kind of the wider capital universe pivot over the last 10 years or so in terms of the types of capital that wants to access the market?
Yeah, I think so. I think, as I mentioned earlier on, private equity is it's not a new phrase now. I think I'm getting older. I established the other day that both my university halls of residence and the first office I worked at in London have now both been knocked down. So you start to feel like you're getting a bit older in the industry. But certainly back then, there was no Blackstone, there was no, Kennedy Wilson, KKR. That they are new entrants to the market in the last 10 years. And I think those types of operators are attracted by all of the things that we've discussed in terms of the UK market is a very mature, transparent market, and one which other than something of a blip of late politically and legally sits head and shoulders above a lot of the other European and global markets. So I think for that reason it was an attractive place for that capital, and I think the returns in real estate, particularly in the low interest rate environment that we've been through, have been very attractive. So it seems to be a fairly well trodden path now that private equity capital of that nature will allocate money to operating partners like ourselves and others who can access and more importantly manage the strategies on their behalf.
Talk to me about surface storage and industrial open storage, as it's probably more broadly known as. Well,
it's an interesting theme that we were pursuing. It was probably 2.5 years ago now when we, through an ownership that we had, which was actually bought as a development site, but was ultimately open storage. And with that, and with another asset that we did a lot of due diligence on, which had a predominant open storage use on the site, we spent a lot of time diving into that market. It's a market that still has very few data points, and it became very clear to us that actually there was a really compelling mismatch between supply and demand in that sector. And I think, what was often the case and still is that occupiers in that space, which increasingly are quite big corporate occupiers, whether it's the EV charging guys or building merchant guys, the nature of the assets was that they were often either sites which were waiting to be developed into either industrial or residential, and therefore these occupiers were only being given short-term licenses to occupy whilst the bigger picture strategy was being put in place. And I think with that we started to see some similarities to what we'd seen in the urban logistics market, where fundamentally the rents, that supply demand imbalance meant that we felt that the rents were going to grow. Clearly they did in the industrial market, and here we just felt they were coming off a very low base, and there was a very the asset class itself, if you can even call it that in the UK, just wasn't being characterized. It was sort of dirt land and really somewhat overlooked from a capital perspective. So it was quite opportune in having identified it as a bit of a mismatch in the sector. Our partner in that fund, NW1 Partners, whose investors into their funds are all institutional capital, a lot of which comes from the US. When we were sitting around talking about what we could do after we'd executed our first strategy with them. We brought this to the table and interestingly, they did exactly the same, because they were seeing it in the US with some of their strategies over there, where the market is 2 to 3 years probably ahead of the UK in terms of its maturity and its acceptance as a subsector of the industrial market from a capital perspective. So it was a great fit. We loved working with those guys in our first fund, and that conviction that they had around the asset class becoming an institutionally acceptable one, which you'd probably argue has just happened in the last 12 months with the likes of Blackstone coming in. And I think we felt really strongly that this was a scalable strategy, and one which we could react quite quickly. So I think we were one of the first dedicated iOS funds, we've just about to close on our 12th asset, which is great. So it's a very high conviction strategy for us. And again, back to basics of real estate, it does. We are talking about the asset management team don't like me to underplay the requirements of drainage and surfacing, etc. But it is a simple asset class with very low obsolescence. And I think the surface brand that you referred to was something that we wanted to use to really try and institutionalize the asset class. Really, it was so I think the brand is intended to provide some consistency of product. So palisade fencing, consistency of the hard standing that we're putting down, both from an occupier perspective, because we're seeing that we've now got multiple deals in discussions with the same occupier, because we've got a lot of new entrants, for example, into the EV charging side. So, they get to see the recognition of the brand and what that brings. But also in the sense of just, creating a platform, if you like, of consistent lease profiles, consistent specifications, etc. So we're really excited. It's it's not an easy sector to transact in, which I think, in a way, I say we quite like James, who's heading up that strategy. Had a lot more hair when he started, but the reality is we see that as quite a big barrier to entry, because quite often you're transacting with sellers who are private sellers who perhaps owner occupied the site for 40 years, or you're dealing with families who are selling an estate, or with resi developers who've had a planning consent or an option which has expired, and so it's not as straightforward as the sort of traditional industrial sector is, and nor are there the data points to really get behind on the rents, because to an extent, you're having to sort of create the market.
But if you can acquire enough of the sites, package it up as a portfolio, brand it as you are, there's an exit of sort further down the line. Yeah,
and I think as you aggregate, and what we often find as well is the occupiers here are actually seeking longer term leases than, obviously we've spent our careers trying to encourage tenants into longer leases, but actually in this sector, because of the fact that they have been moved on so readily in the past, owing to the nature of these sites and how they're used as sort of transitional space rather than defined space as iOS. We're doing a deal at the moment where the occupier is looking for a 30-year lease. So I think and what we feel quite strongly is that when we hopefully get to that stabilized position of aggregated, longer dated income streams, it should become a more institutional asset class anyway, because it ultimately you're buying long dated income streams underpinned by industrial land values, put simply. So we're excited about what we can create, really, and we think there's a lot of scale in the sector as well.
Create an institutional grade product to sell back to the institution, right?
Well, we'll see.
Go full circle. So talk to me about the wider market and your views on the market as we sit here middle of January. It's obviously 2024. It's been a challenging 12 months. How and what is your take on the landscape right now?
Yeah, it's been it's interesting when I was having a look at prepping for this chat. You sort of look at where you were when in the cycle on different decisions that we've made, and what that does do is just show you that this is the cycles they come and and they go, and there are consistent themes through those cycles. But I think it has been a challenging environment. I think we all became very used to a very low interest rate environment, and therefore the yields that were offered in property, as low as they became in some sectors, were still attractive. And I think the most important thing to remember is still offered growth through rents. So I think the sort of direct comparison to risk-free rates and gilts, etc., is an important one, but also one that can overlook the rental growth performance and income growth in real estate. But I think we've been very selective over the last 12 months. Certainly our deal volume has been down significantly on what we'd hoped. But I think that there are situations which prevail in these markets where, unfortunately, there are sellers who are somewhat forced, is perhaps a too harsh a word, but there are motivated sellers, and I think we've become very selective in the occupational markets that we're willing to go to. But I think we still believe in the fundamentals. So opportunistically we're still very active and positive. I think we're keeping a very close eye both on the occupational market, both anecdotally within our portfolio, but also within the wider statistics, if you like. We're seeing very strong tenant retention and generally pretty low vacancy rates across the portfolio. I think the tenant retention might, in some part, be that the cost of moving can be prohibitive, and in a downturn, economic downturn, going to the FD and asking for cash to relocate is a difficult conversation. So the team worked very closely with the tenants to try and understand the requirements and what we could do, and we'll probably come on to sort of ESG and EPC initiatives with occupier dialogue. But so we're seeing quite robust results on our existing portfolio.
That's great. And are you seeing other opportunities in other asset classes present themselves, or? So
I think the other aspect of the business, which I haven't touched on yet, is our Marchmont development management business. Not overly exciting name, but yeah. And really, we set that up with a former colleague of mine from BNP Paribas, Nick Hornby, just over 3 years ago now. And really, that was to do two things. But one was to try and diversify what was quite a binary exposure to the logistics market, which had fortunately been a good thing, but we were conscious that was almost the entire portfolio that we had, and the living space was clearly an area where we felt that the capital appetite was there, and the demand and supply side was also compelling across the different aspects of living. And also really to try and bring in a bit more development capabilities so we could do bigger and more development projects, both in the logistics side and now in the living side. So yeah, that's been really interesting and a big learning curve for me. I don't know a huge amount about BTR, but I'm learning on a steep curve, so I'm enjoying sitting in on the design team meetings and things. But we've got a couple of really good partners. We do a lot with Peveril Securities and looking at opportunities to take measured planning risk, but then with good line of sight to to the execution of whether it's BTR or student, positioning assets into markets which have very liquid capital positions, such as the BTR market. Albeit it's everybody's been affected by the last year's interest rate changes, but so yeah, that's been really interesting. And some of the roles that we've been doing on that side of the business, if you like, is supporting capital who perhaps had investments in longer dated income strategies, which owing to tenant failure or the like have become change of use plays, and working with them to help reposition and underpin value there has been really interesting. So yeah, that's we see the living sector and logistics as being two areas which are we feel we have real expertise and conviction behind the fundamentals.
You got the team in place from a transactional origination structuring perspective, as well as the development capabilities as well, partnering with institutional capital. Do you think you'll ever go back to setting up a fund, or I'm sure you kind of co-invest in the deals yourself, or there's some sort of skin in the game or alignment? But is that a goal for the future?
It is, yeah. I mean, we sort of, it's always been about sort of partnership investing, if you like. So whether that's literally investing alongside or making sure that the alignment of interests is such that, that's in place. I think we made a relatively conscious decision in the logistics market to go down the operating partner model, which I think has been good and plays to our strength. We've got desire to scale, and we think we've got strategies which could be scalable. So I think the great thing about the business being in the control of the three of us means that we can make those decisions really on a case by case basis. So were it to be appropriate for us to actually go and put our own fund together, then we've got the ability to do that. Equally, we've got the flexibility for somebody to come to us and say, look, I'd love to use your platform to get into another sector that we don't have the expertise in. So I think we're quite excited that the different options for the business.
I guess it's the beauty of being independent, right? And having, as you said, three entrepreneurial owners who can pivot and take advantage of the opportunities that are presented. What are some of the learnings of kind of being an accidental entrepreneur, or because you must have a tremendous amount of patience, but also like resilience and determination as well. Because setting up a business, if you're really, really keen, is a hard ask. But what are some of those kind of learnings over the last 13 years?
I think probably we probably touched a little bit on it earlier on. Having the plan but being willing to deviate from it. And I think there's some challenging times. We went through some pretty lean moments, and I think through those moments, that's when you've really got to stick to your convictions, and you go through periods where you wonder whether it's the right thing to do, and you sort of got to remind yourself, I could hopefully go and try and get a real job if I had to, but fortunately to date haven't had to do that. But it's I think being willing to be adaptive, and I think putting teams around you and being accepting of the different skill sets that others can bring. I think when it's your business, that you want to control everything, because whilst I love working for the big organizations, what I do like about having your own business is that, you set your strategy and you do it with absolute belief and conviction. And, if it goes wrong, it goes wrong, but you've done it for the right reasons. And I think, sticking to that, but also accepting that others can bring value, whether it's value like Cam did through a completely, a sector theme and strategy and background, or bringing in the asset management capability, which effectively underpins everything that we do. So I think it can be difficult to bring people in. I think once you accept what the team can bring, and we've got a great team of 12 of us who everybody is bringing different experience, different backgrounds, different skill sets, and trying to provide the culture to allow that to grow is it's exciting. Really, we enjoy it. It's good. It's good fun.
What are you most excited about in terms of 2024 and beyond?
I think that I'm probably going to answer the last question of the day as well with this, but we do feel that the iOS space has got real scale. And I think we're excited at the experience that we've had and the understanding that we're gaining around the planning, around the occupational demand. What's driving that. Relationships with occupiers that can grow. So I think that's really exciting. I think the other thing that we're spending a huge amount of time as everybody is really looking at how we can repurpose and reposition existing assets to meet the new EPC ESG criteria, and it's something that we've always been passionate about, and I think but probably not that probably hasn't led to action early enough. But we've now got an ESG lead in place in Kate, and as a business we've just signed up to Planet Mark. We're really making sure that we're sort of starts from the ground up, I guess, but also just we feel quite strongly that the there's a potential for existing assets and perhaps more functional real estate to be overlooked because the EPCs are languishing in areas that are they're going to cause challenges for liquidity and the ability to lease. So a lot of what the asset management team have been doing really well is looking at how and what we can do with existing occupiers and with vacant units to try and bring those assets up to a standard and beyond where we can, which will not just satisfy the criteria set out by the government, but sort of sit within what we're trying to do as a business. And it's hard. You got to think outside the box. For example, we've got a relationship with Action Funder, actually, which was set up by an old contemporary of mine in the industry and friend, Mark Shearer. And really what he was trying to do, which is probably the hardest of the E, S and G to satisfy is the S. And it's something that we feel quite strongly about. And he provides a platform and a great business. It might be an interesting guest for you, but he provides the ability to effectively execute the S at a local level. So when we're doing a development, for example, in a particular location, we can say to him, okay, this is what we want to do, and he'll effectively go out and source local, or already has a database of local charities seeking support for different initiatives, whether it's supporting children's charities or there's a big breadth of things you can choose, and it allows us to be quite specific with our support, where we're investing or where we're developing. And so that's one of the initiatives that we're trying to do. And it's we feel quite strongly that it's easy to overlook these older assets, but there are things that can be done which will improve liquidity and underwrite returns, but also support what we're trying to do at a corporate level.
Amazing. Well, look, as you touched on, as we draw to an end of this conversation, a question I ask everyone on the podcast is, if you had £500 million worth of capital, who are the people, what property, and which place would you look to deploy that?
Yeah, well, I think, to take the last one, the place, I think the UK has always been the market where we've got the most experience, really. So in terms of our ability to add value and stand behind our credentials, that's really where we are. I think people have done some fantastic jobs in some of these European markets, and maybe we've missed that. We're not ruling those out. I think if we were to go into some of these European markets, we would need a partner who, like us, was embedded in that local market, such that we had real conviction around their ability to execute. But so I think the UK is where we would be, and I think the reality is, in terms of scale, we think that iOS sector has real scale, and I think we've got a relative early mover advantage in it. So we're excited about growing that platform. So I think for now we'll stick to that. But opportunistically, we're still seeing some great opportunity in the logistics market.
And in terms of people, is there anyone along the journey that you'd get involved with?
Yeah, I mean, to be honest, the thing I like most about the industry really is the people that you're fortunate enough to meet. So it's I learned a huge amount from James and Colin at Tritax, who remain good friends. We laugh that I just got out of that sinking ship in time before but no, I mean, the mentors like them, are great to have. And it's been great to see them grow. And I think. Is there anybody that we'd like to work with? I think, we love people coming to us with ideas, and we're very open to that, and hopefully that'll be one of the ways we grow over the next 5 years with new partners, new platforms, which is the exciting bit.
Well, Tim, you've had a fascinating background career, and I've loved finding out a little bit more about how you set the business up, why you set the business up, and how you've kind of evolved and pivoted and taken advantage of the opportunities that have presented themselves. So thank you so much for joining me.
Pleasure. Thanks for your time.
Thanks for listening to this week's episode of the People, Property, Place podcast. If you found it insightful, feel free to share it with a friend or colleague. Give us a rating, like, or comment. It helps tremendously. It'd be great to hear from you on LinkedIn. I'm super open-minded to recommendations of guests that we should have on the show or areas of the market we should explore further. So do drop me a message. The People, Property, Place podcast is powered by Rockborn. The team recruit leadership and future leadership hires for real estate owners, funds, investors, and developers. So if you're looking to hire top talent for your business, head over to the website www.rockborn.com, where you'll be able to find a wealth of information, or feel free to drop me a message on LinkedIn. Have a great day wherever you are, and I look forward to catching you next time.